Okay, Rohit, are you here? Looking for
Yes, I
you.
can. Yes, I can hear you.
Okay, using the camera, let me look for you. There you are. All right, so I feel like we're, you know, brothers. We've been talking to each other so frequently lately, Rohit.
Yeah.
So, it's great to have you here. I'm happy to talk to you about what you're seeing in the markets. Why don't you tell our our attendees a little bit about how you developed into being a strategist and a mentor, and what kind of method you gravitated to, a little bit about your journey before we dig into the markets. um, and that's always a treat every time I see your chart. So how did it begin for you, Rohit?
Yeah, that's a good way to start. So really as a teenager getting interested in stock markets and thinking how should I make money here? And so you approach it from every angle, technicals, fundamentals, economics, start studying, learning. And I think spent 7, 8 years doing pure technicals along with fundamentals, reading balance sheets. But I only started to do Elliott wave analysis from say 1999. And the big differentiator there was that if I use classical technicals, what I found is you always feel confident that you're going to be right about the trade, but not every trade ends up being a winner, which we really realize when we do back testing on any single or dual indicator system, that more than 50% of the trades end up being losing trades. So Elliott wave analysis really gave perspective in terms of having a view. I think it's the only part of the entire market science which allows you to take a view on which direction the markets could take and actually calculate, using Fibonacci ratios as to what the length or extent of a move could be. Now, when you put that together with everything else, one with technicals, it allows you to have a better execution system. So it's not that I use standalone Elliott wave analysis, combine it with classical tools for execution, and you have a better trading system that has a higher strike rate than 60% at least, if not 70, in a good trending market. Second is you're able to also understand what the market is doing in terms of the macro outlook. So you combine it with economic cycles, study the long term, and the long wave or quantitative cycle, as we call it, is really useful when you combine it with Elliott wave analysis and understand the debt cycle, credit cycle, and how that really works. And the third aspect is combining it in individual stocks with their business cycle. So I call that the value wave, where a stock in its early stages, wave one, wave two, is really in the value phase. And then that's when people are trying to judge when will it go from value to growth. And the clear development of an impulse is the first sign that people have gotten interested in the stock moving from value to growth. And then the second wave offers that opportunity to entry. So if you're able to identify that on the long term and also look at it fundamentally that it's in the value group and in wave one and two, then you're at the start of a multi-bagger move in individual stocks. So that is where a wave analysis in combination with what the numbers are telling you on an individual company can really help you identify long-term investment ideas. So different ways and applications that I found once I learned Elliott wave to each part of the science and putting it together. Even in macro analysis, once you start doing wave analysis of things like the dollar, currencies, commodities, and the bond market, you're able to make those linkages as to when those turns are occurring along with equities and what kind of impact they're having, what are the interrelationships. So that understanding became far more stronger in putting it together than it was prior to doing it in this way.
Okay, intermarket analysis, where it's a big financial jigsaw puzzle and you see how things relate to each other. As far as Elliott wave is concerned, are you self-taught? Did you start off with Prechter's book?
Yes.
What was your primer for Elliott?
Yes. I think Prechter's book was the one that was sent to me by my brother from the US when I said I want to learn this. He said this is the book that every book seems to be referring to, so he sent me a copy. And the way I did it is like there are a lot of skeptics to Elliott wave. So when I teach, I actually tell people I didn't open the book and try to figure out whether it works. I said, okay, let me just open it, read chapter 1, apply chapter 1, read chapter 2, apply chapter 2. And I started to write my weekly notes at the firm I was working, writing my analysis based on what I was learning. By default, the accuracy and the feedback loop in terms of what I was putting out improved significantly. So the confidence came from actual application and doing it rather than trying to judge, does it work? Because most people just disregard it upfront without really having put it in practice.
Yeah, because it's not the wave structures that don't work. It's the interpretation or wrong interpretations of the rules, and not understanding that even in Elliott there are alternates.
That's right.
Right? There's always an either or. How do you come to judge what's your preferred count and what is your alternate count? What makes one preferred?
So we look at two filtrations. One is, of course, whether we can really cancel it out on the rules itself. But as your question is, how do we choose? So if I'm left with two alternates, we can filter out on two aspects. One is what is the sentiment setup, and second is what is the momentum setup. So I do give importance to the momentum setup in combination with maybe a good rate of change indicator, moving averages, Bollinger Bands. Look at all that and how are you set up in terms of the structure. Does it favor one particular count versus the other at that point of time across time frames? So a minimum of at least 2 time frames. You look at everything from monthly, weekly to daily, and then look at what the sentiment is telling you. And sentiment is a very wide field. Apart from just looking at maybe sentiment surveys, you also look at derivatives data, whether it's put call ratios, whether it's the positioning of traders, discount in the futures market or a discount or a premium in terms of what the indices are doing. So is there a backwardation or a long, and what is the average of those premiums and discounts on a chart? And then we can look at the breadth indicators. So all of this is part of sentiment analysis. Knowing where the sentiment is at that point of time also helps you judge whether the wave count is correct or not. Have you really reached an extreme in terms of the fifth wave? Are you seeing that divergence between the third and the fifth in sentiment data? And that's where putting, so using sentiment layer and using our momentum layer, I think we're able to choose which one should be our preferred wave count.
Okay, so let's say a preferred doesn't work out, the pattern is broken. Do you, besides come out of a position that was based on it, move right into your alternate count, or do you let the dust settle and reassess for some time before you take another position?
So surely there'll be some time, but between the trade management and the execution, there's a lot of difference. So this is what I tell people. People would think that, okay, if you change your view or your wave count changes, you probably did not adjust your trades till that point of time. That would be a losing proposition. Trade management is a far more superior concept and needs to be done pretty fast.
It's everything.
It's everything. So I think it comes on top of the list. It's the last thing that we teach after we teach technicals, we teach Elliott. We actually teach them trade management. And that's like the most important part. People would think Elliott is the most important part, but it's really the execution. How do you get out? How do you reverse? And then how do you build a trade? So even if you have a view, it's not that, okay, I have this view, so I go and buy out everything tomorrow. So you have to do position sizing. You have to spread your trades out, sometimes not against the trend, but actually in the direction of the trend. So a lot of people think of position sizing as average on the way down. Why would you average a losing trade? So it doesn't make sense.
Is one of your favorite things in trade management, besides taking profits, moving or stop to a break even or a round entry, so that now you have a trade on and it's riskless?
More than that, no, yeah. So, well,
my blood pressure goes down.
That's the quick exit thing. But I think starting with a smaller size sort of sorts that problem out. So if I want to bet 100, I would probably bet 20 first. And then wait for more indicators to confirm whether what I'm seeing is happening. So in that sense, then I'm risking only 20 if I go wrong on the first go, and therefore my loss would be much lower. So I think of it that way in terms of reducing the loss, rather than that I should move my stop quickly to the cost, because sometimes moving it to the cost might not mean that your view has changed, and so that access.
No, go ahead. Go ahead.
Yeah, so that acts as a good risk management, but it will throw you out of a good trade as well. So the better idea is then if you want to reduce risk, you start with a smaller size, and as the trade confirms that yes, it's doing what you expected, you increase the trade size.
Okay. And, break even isn't necessarily a good market stop.
Yeah,
Is also, even though, but you could do you trail stops on your positions?
yes.
You trail.
Yeah. Yes.
Okay.
You do trail.
Okay. So let's take a look at what you brought for us to see. I mean, there's a lot of talk about, relief, a little bit of relief in the market now after Friday. Maybe the world changed for a few weeks. In fact, you and I talked a day before. It manifested, and that's exactly what you were looking for. Risk on in S&Ps, pullback in the dollar. Yeah, nice calls. And do you feel more conviction and feel confirmed that before they were forecasts and now they're manifesting?
Absolutely. Absolutely. The last 2 days are giving a lot more confidence. And this also after the Indian market has actually rallied ahead of the US. So in terms of positioning here, it's giving me more confidence that it's going to stretch because we'd already done a 61% retracement on the Nifty. And the question was, are we going to extend more? And that really required the support of, all the other things falling in place, which we discussed. And that seems to starting to happen. Which improves the case for even the Indian market going still further higher. So definitely the case is improved, and that amid all the gloom and doom talk which has been around for quite a while is makes it even more interesting because a lot of people get caught off guard these rallies if it is a bear market rally, and of course then we start debating, can it be something else? And
Yes.
that answer I don't have. But at least we've got the first sign to get ourselves positioned for the upside. Once you're positioned correctly, you can always take a judgment call later on, if things change for the better.
The art of this is not if, it's when.
Yes, the timing
right?
of it.
You want to show your charts by sharing your screen here, Rohit?
Yes.
And perhaps you could start with the Nifty, because when you were on Face a few weeks ago, you were projecting a new high in the Nifty, which had a much better structure going in than the S&Ps did. Obviously,
okay,
you had some type of megaphone.
I did have a slight narrative to go through before I got to the Nifty.
Oh, okay, sure.
Which is essentially around the dollar, because the dollar's been the central problem that everybody's talking about. And I'll not only highlight where I got it right and where I got it wrong, but also how it really changed and how I'm mirroring it with what happened in, say, in the 1990s. So I'll just go through with it. Some 5-6 years back, I drew this chart. I said, okay, we are seeing a cycle of the dollar moving up for 7 to 9 years, then down. So there was an alternation: 7 years bear market, 9 years bull market, another 7-year bear market. So I said, well, from 2008 bottom, maybe we get another 9-year bull market. So that ends in 2017. 2017, we had the DSI, the Daily Sentiment Index, hitting almost 97% at this peak. And so that was also looking like maybe we have a 5-wave done here. We have extreme in sentiment, positioning, everybody's long the dollar. Maybe we've ended a 9-year bull market in the dollar. So that ended up being a very good call in terms of thinking that, yes, we did get a dip. And that meant reflation assets, buying commodities, buying gold, buying metal companies in India. Those trades really paid off between 2017 to 2020, a lot more during this phase, because the initial phase here, we did see gold bottom out. But most of the base metals and mining companies, especially those in aluminum, copper, etc., did really well in this point of time. But my sense was that if we're going to continue this cycle, it would be a 7-year bear market, which means 2017 to 2024. This is sort of where I've been set back a bit, but not really a lot, because we managed to change the trade and the markets remained elevated for longer than the dollar was rallying. And so the dollar index has broken out this year, which means we are no more in this 7-year market. And in fact, last time you also asked me, do I pay attention to time? And here's one more case of time failure. So there have been so many studies in which I've seen time failures that actually, while we do put it anecdotally to get a sense of what may be happening. I don't let it override my thought process. And what we have here then is, I think 2017 to 2021 is around 4 years, a 4-year kind of bear market in the dollar. And once again, we are headed up. So then what I ended up doing, and this was also a thesis I had in 2016 before I called the top, I thought that we may be repeating something like what happened back here, which is that the initial dollar rally, which is this phase, up to around 1996, created havoc in most of the emerging market countries. So if you actually go back and study, you'd find the Southeast Asian crisis, 1997, the Thai baht crisis. All of that happened in that first wave. So I call it the first dollar wave, which in Elliott wave sense, we can say this is AAB. And then there was wave B, where a lot of the consolidation happened. Things started to look better. Those markets stopped falling. And then you had the second wave of the dollar, which is your C wave. Now, when you had the second wave, it really did not create a crisis in those emerging markets. What ended up happening is most of them recovered into what we can say first waves in those markets. And then during C, they just corrected back into, which means they did not make a new low. That set them up very well for a third wave bull market, which is what we've seen through this phase, the emerging markets and the commodity linked markets. So I started to sense, whether something like that was going to happen in 2017, and then it went into a deep dive and it didn't happen. I think it's happening at a much larger scale. So if we actually look back, 2008 to 2020, we've had crisis in everywhere. Brazilian bonds had a crisis. Turkey went into hyperinflation. Zimbabwe, we can keep listing. Argentina had its problems. So all of this emerging market crisis we've actually seen in the first wave. The second wave is where you see many of these markets take off and start doing pretty well. So that's also what happened to India here. We did really well because we were in the tech sector and there was the tech boom going on globally. And so we ended up getting our first wave of recovery in the core economic sectors, which were actually in a kind of recession in the early 90s. So we've seen something similar post-COVID. I think most of these markets have done really well. But they're really not making new lows. That's the important part. While the dollar index is taken off to a new high in a record move, and in both these cases, here, this second wave and this second wave, it's really the crisis of the dollar has been centric to what is happening in the US and not really the emerging markets. So I think that's the big differentiator. So when this second dollar pop happened in 1998, 99, it popped the tech bubble. Right now, it seems to have done something similar because you have the NASDAQ leading the way down. It's really not an emerging market crisis anymore, even though we do think that the dollar debt in emerging markets would be a problem and so on. But many of those problems were already hitting some of these markets, and actions have already been taken. Like for in India, when we hit 69 to the rupee with a lot of dollar swaps, and we've been building our currency reserves, so we're in a better position in that sense, and have not really fallen off the cliff, even though it would have looked like that should have happened. So
how many years left in this phase of a bull market? And your purple lines there, if we ever, just looking at that formation, say 90 to 105, that's how people come up with 120.
Yes, so if we just take the size of this move and project it, or we go to the top end of this channel, it's somewhere above the 120 mark.
Okay.
But a large part, so what we should really think about is the most significant part of this dollar rally is done. So now when we are hitting this, it's like this phase where you're forming an ending diagonal. The last phase, you're still making new highs, but it's more of a distributive late phase thing. So I don't know how long it goes on, but it's likely to be much more, contained in that sense. But some places might still face a problem. Some currencies might still fall off a cliff, but the DXY, which has been falling simply because of the yen or the pound, that may slow down compared to what we've really seen. But what I'm really trying to highlight here is what it resulted in is an opportunity in the commodities, emerging markets, and other spaces, because they all need second wave declines very long term when we think about it. And I think that is the opportunity that's coming at the end of this. Some markets may even bottom earlier, some later. But the thing to really watch out for again is the very same places that started to do well in the post-COVID wave are the places where we would look for investing in post this crisis coming to an end. So that's the thing to keep in mind at all points of time. We can time where the crisis ends, where to make our entries, but the places to focus on from long-term investors is going to be, I think, still be in emerging markets and the reflation trades, what we were saying, the electrification trades, the EV trades which are being put on. I think all of those really come back because those are long-term themes that are not going to go away.
Okay, and how much time do you think we have left in this dollar cycle, and for long-term investors to come back to the long side of the market? How long?
So with these time cycles really being put out of whack, I'm not sure how much time to put it, but let's say the size in terms of length of bear markets in India, I've seen 18 to 24 months kind of an average length of bear market. So somewhere between 2023 and 2024, I think the worst is over. So we still have another year max for things to, whatever worst is left to happen. And after that, I think you will see things change. And when that happens, I think EMs outperform the DMs. That's sort of the trade I would put on.
Rohit, good afternoon.
Good afternoon, Steve.
How have you been?
Great.
Nice. Tell me something. Under the current market environment, what is the clearest thing out there for you at the moment? Because yes, we are going through a cycle at the moment that is still ongoing. As you very well said, and I agree with the last part as well, you said that probably the vast majority of the dollar appreciation has already taken place. So chasing the dollar higher is not as simple as it would have been up until a few months ago. It should keep appreciating, but the pace will probably end up slowing down. So if you had to choose something with a shorter time frame horizon in mind, like a few weeks, a month or two, what in your opinion would be the most interesting thing out there at the moment?
So to put it rightly, what would be the trades we would take on? So I'll move to the later part of the slide where I've discussed the near-term setups, both in India, US, commodities, and I think that's where the trades are. So let me just get there. Just last week, Dale and I were talking about this, and this is the setup for the NASDAQ composite, for example, and I think most US equities would behave like this. In fact, most of the US bear market has been in the form of an ABC structure, which is a zigzag, as we call it. So you had this first wave, a deep retracement, and then an elongated C wave, which breaks up into 5 waves. Okay, that's the important part to highlight.
So you think we're going to have a repetition of the exact same structure, as a rather shallow wave A and an extended wave C?
We've already started wave C, so that's the part I'm coming to, and that will tell us where we are right now in that structure. So now let me just go to the next chart. So what we are looking at here is essentially where we are. So we've completed A, we completed B, which is the top in August. A is also interestingly a leading diagonal in the S&P and the Dow because they're overlapping, but in the NASDAQ there's no overlap between the 1 and the 4. And because there's no overlap, here we can call it a normalized 5-wave decline. The wave B has done a good 50% retracement on the NASDAQ, almost a 61% retracement on the Dow, and a 50% retracement on the S&P. So which is very much in line with what B waves do. And we have started the C wave, and within C we've completed the first. So C is the elongated wave, will subdivide into 5 waves. We've just completed the first decline in 5 waves at the recent bottom. What I'm looking at right now is the trade which we are taking on is being long on the S&P NASDAQ with the expectation of a 50 to 60% retracement, 50% or 61%. So somewhere between 11,500 to 12,000 on the NASDAQ, could be closer to 4,000 on the S&P.
Yeah, for people that are not very familiar with Elliott waves, he's looking for 50 to 60% retracement of the last move down, not of the whole bear market that we've had so far. So back to, what is it, 11.5 to 12,000?
Yes.
Okay,
and
perfect.
around 4,000 on the S&P, that would be. But that's the best case scenario. I mean, 4,000 is 61% if we get that far, if not 50%. And that would be the second wave of this pullback, should complete ideally in 3 to 4 weeks. maybe by end of November. And then we should probably start wave C lower, which should be taking us towards maybe 8,500. Now, why 8,500? 8,500 is also where wave C and wave A would be equal to each other. Okay, and but that might not be the final destination, because wave C is going to go into 5 waves. So this might only be the third of the fifth, and there'll be a fourth and a fifth. And typically after a leading diagonal in wave A, the wave C tends to extend even up to 2.618 times, which is therefore going to make it very much like what we saw in 2008, an extended C, but also in 2000 there was a large extended C. So I think the setup is for that. And 7,100 is where it would be 2.618 times of wave A. So I think that's possibly the overall picture. We would do 2, 3, 4.
So you're looking for a lot more downside in equities from where we are.
Yes.
What do you think, assuming that this big sell-off is going to take place, which fundamentally speaking, I'm 100% with you. I mean, I believe that under current macro conditions, the chances favor a lot more downside in equities. The more the Fed and other central banks are fighting inflation, the more we're going to be seeing all these games of zero interest rate policy and monetary quantitative easing madness unravel. The question is, if this takes place, how do you think FX is going to respond to it?
Yeah. So it will, there will be, like I said, the dollar may slow down its advance, but might not completely reverse. So that's one part. I'll just go back to the dollar part, dollar chart. Mm-hmm. It will be easier if I just switch back. I have a dollar wave count right here. One sec. See, I had put up, yeah. So essentially what I expect is that some currencies, like for example, the USD INR, now being in India, we trade more of the INR pairs.
Makes sense.
So the USD INR actually has a lot more upside than I would think the dollar index itself. Now, in dollar index, of course, between here and 121, there'll be several rallies and pullbacks like we've actually seen. In fact, through most of the rallies in the DX5, what we've actually witnessed is that sentiment has always reached an extreme. Okay, so and every time we've seen that, and by sentiment, I'm looking at the daily sentiment index. So each time we've hit, say, 92%, 95%, 93%, we're getting these pauses, which are mild pullbacks, retracements of the last leg, and then a further extension. So as long as we are continuing to extend, I am maintaining that the trend would remain positive. There will be small pullbacks, which is what we are witnessing right now. So this could be a consolidation, pullback, and then we get another wave up, consolidation, pullback, another wave up. And each of these waves, I think, will hit certain currency pairs. Definitely, I see it in the INR. There may be many others in the emerging space. Could be less effect on, but definitely not the end on the USD JPY. I think there could be further sell-offs in the future once it consolidates. The trailing point for this entire move, though, is going to be the 20-week average. So if I look at the entire move from 2020 onwards, we find the 20-week average here acting as support. And so I'm keeping that as my trailing continuation, which is currently at around 108.2. So unless we really go below that, I would maintain that we are still in an upward trend for the DXY. And so every pullback, every consolidation will give us a setup to really initiate another trade for a higher move in the USD.
Assuming, of course, that if indeed equities start accelerating to the downside eventually, probably then the commodity currencies are going to be doing worse against the dollar than, for example, perhaps the euro or the pound then, right?
That's right. In fact, that's partly what I was highlighting. If we actually see here, this is where the Y2K bubble really popped with this dollar run. We don't see a lot of a move here in the DXY itself, but we do see a lot of weakness in equities. So it's not necessary that, just because equities are falling, we see very big moves in the FX space. So that is sort of what I wanted to highlight. So where will you see moves? Will be in some, probably in other places. Still maybe in the bond market to some extent, because when I look at the bond yield chart, okay, so this is what it is.
Mm-hmm.
This is a rather oversold market. This is the 30-year long bond. And we are probably at the end of a third wave. The sentiment's been hitting an extreme recently again and again. We're somewhere at the end of wave 5 of 3. Give it a few days here and there. I think we should see this sell-off come to an end and start a rebound. Now, rebound wouldn't mean a very sharp move. It can also mean a long consolidation. Being a triangle in the fourth wave is also typical. But that would provide relief that you would not be seeing new highs in yields. It could also come with the recognition of a recession. Typically, bond markets start to rally once you recognize that, yes, you have a recessionary condition, which is probably still not being recognized, which is why bonds and equities are falling together. At some point of time, that inversion would happen once recession becomes more widely accepted, and then you have a risk of where people want to buy safety and sell bonds. So that could provide some of the demand for bonds and hold them in the fourth wave for a while.
We're going to go back to the more usual inverse correlation between equities and bonds. Yeah, makes sense. And this consolidation or recovery in bonds, of course, can come and should come along with this rebound you talked about in equities, right? Within the next few weeks, because at the moment the market is in a mode that higher rates put more pressure in market understanding about the fate of equities. So we've seen these move in tandem. So if bonds have a relief rally, rates will move lower, and perhaps this way equities might recover. What about, I saw before as you were circling through your charts, you have prepared some charts having to do with gold, silver, I assume crude oil as well. I think people would be very interested to see what you think about those assets.
Yeah, so I was actually drawing into starting with commodities into the correlation, which I was saying earlier, that as you're seeing the dollar really run into new highs, we aren't really seeing commodity prices make new lows like they were making between 2009 and 2020. So what we are really looking at is a second wave correction in the commodity space. Now, within that, there are opportunities in the short term, which is, so when I was drawing these charts, I was essentially trying to highlight that longer term, these are all second wave declines. Now, the question is, are we done here? Can we be done here? Say, for example, in copper, we've already retraced 61% of this entire rise. So are we really done in terms of the advance? Now, because it carries such a high relationship with the dollar, it's become a little hard to call whether you will still have one more leg down if the dollar keeps going up before we really start the third wave up. So I'm keeping that open. But in the very, very short term, again, coming back to the main idea that we must have a trade, there's actually a long trade in the commodity space, and specifically copper. So I'll just take you to a shorter term chart. So what I'm looking at here in copper is the completion of either a 5-wave decline or a complex structure. Okay. And in fact, here we are down to 7% on the DSI when this low occurred. We're also seeing multiple divergences, which again give us that, confirm that we are getting this reflation, or rather risk on trade right now is either rising bond yields or rising dollar, or the rising dollar is not having the same negative impact it was having earlier, either on equities or on commodities. Like we're not seeing a new low in copper prices for the time being. So my sense is it started forming a triangle. It's broken out of this triangular formation. There was a risk that, okay, what if it continues to make lower highs? So I've drawn this small little line here for the last 2 days that if we break out of this, then that's another sign that This is not a lower high, lower top formation which will break down, but possibly something that is reversing course, because both my daily and weekly momentum indicators are in buy mode right now. And so that sort of helps the case that we are developing a situation where the copper prices could actually start bouncing back and heading back to the top end of this channel in what we will then end up marking as a ABC pullback, which is slightly larger. Similar things. Yes.
Oh, okay. And real great view of copper. I was taught that the white stuff goes first, which I'm talking about palladium, platinum, silver. Are there better structures? Platinum's acting very good. Silver, better structure than copper?
So recently, silver has been a little bit of a pain. Very volatile.
Tell me about it.
So I have actually, put gold and silver on a slight back burner. I have not been writing updates too often on them, but focusing more on the base metals, which is what I find more interesting. In fact, even oil. So I'm sensing that even oil has started and like we discussed the other day, the Brent chart is actually better than the WTI chart. It's even close positive on Friday. And in that sense, I would think it's going to attempt a move towards this line closer to around $108. In fact, I wouldn't even be surprised if NG, I don't have a sign on NG. I thought it would pause. It's still falling.
Well, the Widowmaker.
Oh, yeah. Otherwise, I was actually...
Does your wife let you trade natural gas? Steve, you too. It's a the Widowmaker. So I'm wondering if your wife's let you trade it.
No.
That's great.
I made sure she has no interest in financial markets.
Well, don't tell my wife. She might force me to trade
it. All right. Great stuff. Blake, you have anything you want to ask Rohit?
No, I just want to say, Rohit, you're getting a lot of comments on what a great, technician you are. You really, you're one of those standouts that I've automatically been attracted to what you do, because you don't make things complicated. You keep it very simple, and you let the charts do the walking. So great job today.
Thank you. Thanks.
I discovered him, Blake.
You did, and you know what? He does awesome work. Hey, I don't know if you've had the opportunity. Did you get a chance to go through because I missed some of your presentation. Did you go through the Nifty already?
That's the one I think I left out.
Oh, well, let's bring that up, because I think a lot of people want to see how you view the Indian markets right now.
Yeah,
so nailed it, Blake.
Yes, and in fact, Dale asked me that question right at the front, and I said, let me first, cover rest of it and then come to the index. So on the Nifty, first long term, I have the same setup, which is what I've been saying with the relationship to the dollar, that these are all second waves. So even India, I think, is some degree of a second wave. We are holding out pretty well, so it's not really falling with the rest of the world. It did look like it would into June. But now, as the US market made a new low in September, we actually made a much higher bottom. We didn't even retrace 1% of that fall. And so that has brought back a lot of people feeling the fear of missing out and wanting to participate on the upside. There are also certain sectors. In fact, there's been a lot of sector rotation. So even though the index may not be making new highs, we've had different sectors make a new high at different points of time during this period. And the judgment I've been trying to make is whether that's a rotational distribution setup, because some sectors have also taken a big hit, like IT stocks. The information technology stocks from January to now are down pretty, almost 40 to 50% in some cases. We even saw that in the metal sector because of commodities. But in places like the automobiles, those sectors have actually made new highs. Autos, power, capital goods are making new highs. And so people are sensing that, well, India is really decoupling from the rest of the world. But the fact is, every time we've tried to say we are decoupling, we've been slapped in the face. And so that's not something you want to jump to as a conclusion till we can really say that the worst is over. So I'm keeping the risk open to the downside. However, in the short term, we have a similar situation where just like the US, we have not just a 5-wave decline, but also extremes in sentiment. In India also, we ended up seeing extreme sentiment readings. Just like we saw at this bottom, we've seen similar readings here. For example, the futures market had significant short positions built up, almost 145,000 contracts short at that low. And even though we've rallied, up to 61% of this last, still at around 60,000 contracts short amid institutional investors. So that has not changed. And simultaneously, the US market is still in bounce mode and not done. I think that we are going to overshoot. Already the overnight futures are indicating we are going to overshoot the 61% mark. So I'm looking at going to the top end of this range, which is the trend line of the highs closer to around 18,300. The all-time high is 18,600, so it'll put us in kissing distance of the all-time high. And there's a strong set of bulls saying, oh, we're going to 19 or 20,000. I'm still not jumping to those conclusions. I think the risks are still there, especially looking at the currency and bond market in India. I think eventually this rally will fade, and if the third wave to the downside plays out in the US, it is going to hit our market as well as it usually does. But there's a trade here in the short term, which is from where we are at around 17,600 to 650 to around 18,300 that we can actually take, and then we'll wait for actual signals that the next decline has started to set up a short trade.
Great interview.
Perfect.
Nice presentation.
Yeah, and I was going to say, I it's interesting that you say that you play that on the short side, and it's I think it's what a great risk reward if we should make it up there.
Yes, it will be a great risk reward. In fact, our market's been a pretty much up-down market, so all the way till January, which is here, I was actually maintaining that we were still in a bullish trend. So I was being only in the long exit kind of trade for the market.
Rohit, I was just going to mention, you may have missed my comments a little earlier regarding, I think, some of the beneficiaries in the coming years as people deleverage away from China is going to be countries like India. And, so I'm not saying that the markets are going to hit new highs now, but I think in the years ahead, there's some pretty good upside available.
Yes, which is why I'm saying it is a second wave down. And at the end of this crisis, we have to be looking at emerging markets, and the reflation trades all over again. The ones that were working in 2020, 21 are going to come back. So that's less of a doubt. It's just that we need to sit through this crisis and time it correctly. And in the meantime, it's an up-down market. So you're getting these wild swings and good opportunities to trade long, short again and again, which is what we're really trying to time and do for now.
You're also looking for a pullback in rupee. I know we're running out of time. You just want to show that chart. Someone said, yeah, it's going up because the rupee's collapsing. Yes,
I'll jump onto the rupee. So this is my long-term setup on the rupee. It has extended what should have been the end of a normal fifth wave. So the normal fifth wave would have been, well, if it's equal to 1, it should have reached around 78, 79 and topped out. It could have formed an ending diagonal over here, which it didn't. And so I was forced to change that count to a running flat in wave 2 of 5. And so now we are in wave 3 of 5. Now, if the third and the first wave are equal, we go to somewhere close to 86 or 87, depending on how we measure one, whether the entire range or whether we take only to this top. We get a range between 86 to 87 for this first wave, but for the third wave. But being the third wave, because it can extend 1.618 times, would be all the way to 93. And so I'm keeping both of these levels open, either 86 or all the way to 93 before the third wave ends. And so it's not over. And in fact, this is another good trading opportunity once it pulls back. Right now, in the very short term, the momentum setup is actually on the sell side of the currency. So if I just show it to you.
So it'll have some relief with the dollar pullback as well.
Yes. So here the momentum, we have a negative divergence there, and the indicator remains in sell.
Drive.
So it's sort of, and the bands are contracting, so the volatility is really coming off. I sense it'll come back to the lower end of this range somewhere here, around a rupee down, around 81, 81.20 should be the support. And once it is there, I think we start another leg higher. So that's where we'll really look for entering the USD INR again.
Perfect. Thank you very, very much, Rohit, for your views. I think we covered multiple markets and looking forward to having you again.
Follow Rohit on Twitter at India Charts.
India Charts, very easy handle to follow for sure.
Thanks, Blake, Dale, Steve. See you again.
Thank you, mate. Bye-bye.
Thanks for being
with us.
Thank you, Rohit.